Okay, this is going to be a video on chasing. Chasing is when a stock gaps higher, and before taking the time to watch the initial moments of trading, you automatically just buy the stock no matter what. Your emotions get the best of you, you see it moving, it gaps up 5, 10, 15%, and so you're buying. You've already made up your mind. This is called chasing. This is a bad strategy because it doesn't allow you to evaluate any type of technical analysis, which is very important in helping you make successful trades. So we're going to talk about what to watch for from an intraday chart to eliminate the uncertainty that comes with chasing. Because when you chase, all you're really doing is hoping that the stock just moves higher. Now, what you'll notice in this video that we're going to do, you won't always get the best possible buy-in price, but we promise you that you will get a much higher level of certainty with the trades you are making. So we're going to use a couple stocks for examples, and we're going to focus on a 5-minute chart of the last day and a half's price action to show these examples. Now, our criteria is going to be very simple. Wait, see if the stock can break the high from the open, and then you can buy in and catch a move higher. Otherwise, the stock will likely pull back and fill its gap up before moving higher. So, NSRS 5-minute chart. Good example. A gap up from the Friday close of 67, gapped up to 75. So, and then the high was 774 within the first 5 minutes. So now our criteria is if NSRS can break 774, we will then look to buy the momentum on the breakout and catch a move higher. So you can see by 9:45, NSRS did break 774. So NSRS did break that high, and you can see it was then able to run all the way up to 84 cents. A very nice profitable trade from 77 up to 84. Now, again, we sacrificed being able to get in at 73, 74 cents on the initial gap higher, but we eliminated a little bit of uncertainty by having patience and waiting, and then we were still able to catch a nice move. Sorry, just had to pause something really quickly. So the focus here is not on the best possible return, it's on the best possible risk-reward scenario and setup that we can take advantage of. Here, buying at 73, 74, 75, remember, all you have to go on so far is this action. So we would rather, seeing this, just wait for a break of that high, because then if we get that, we know that psychologically other people are watching for the same break as us, and when you get the break, people like us will be buying, and it'll become kind of a self-fulfilling prophecy where you get a breakout. So yes, we're buying 2 cents higher, but we're not just guessing and hoping for a breakout. We're able to have much more certainty with our strategy. And that, in our opinion, is even more important than potential gains, because in the long term, certainty in your strategy is what's going to add up to the monster gains on a consistent basis. So let's look at some other charts. HWIC, this stock gapped up today from a penny up to 129, and the high was 1.5. After the first 5 minutes, right away it broke this high. So you got your signal early. So you could have bought in 1.5, 1.6, 1.7 and caught this entire move up to 429 and made 100%. Okay? And this works on more than just penny stocks. ROYL, Royal, gapped up today from 454 to 466, hit a high of 470. So now we're waiting on the break of 470. Well, we got it around 11:10, so about an hour and a half into the day. And you can see after the 470 break from the opening 5-minute candle, it went on to hit a great high of 539. Those are great returns right there, from 470 all the way up to 539. An even higher price stock, Priceline. Yes, Priceline gapped up as well from a 544 close up to a 549 open. The high was 558. The very next 5 minutes, you got your buy signal at 558, and the stock now is at 572. If you're playing options on Priceline, you could have easily made 100 to 300%. Okay? So, once again, sure, we are sacrificing an entry here in this range, but we're going to point out why you do that in just a moment. Amazon gapped up from 185 close on Friday to a 187 open today with the high around 187.20. Got the buy signal right here on the high break from the opening 5 minutes, and here we are, up, hit a high of 191. Again, if you're playing options, that would have been a very, very profitable trade. So now, undoubtedly, what you're saying is, well, why aren't I just buying in the first 5 minutes? All of these charts you've showed me have went on to break those highs within the first 5 minutes. I could have made more money if I just bought right away. Well, now we'll show you the other side of the coin. Look at Apple. Apple gapped up. Okay? You can see it closed at 493.69 Friday, opened at 499 today. First high in the first 5 minutes was 503.83. Well, if you bought calls on Apple within these first 5 minutes, you bought when they were at their maximum value with their maximum time decay factored in, minimum time decay factored in, and you can see Apple never broke the highs of those first 5 minutes of the day. And it's gone from 499, it's gone down to 499. So from 503 to 499 in the options world is going to result in substantial losses of probably anywhere from 10 to 40%, depending on which strikes you're buying. SPLI. You can see, first 5 minutes of the day, opened around 7.8, hit a high of 8 cents. So you might say, oh man, it looks great. Huge volume. Looks like it's going to break 8 cents. Well, look what happened. It never could break that high of 8 cents. And the stock has since trailed off on lower volume here. Right? So if you bought within the first 5 minutes of the day, if you got excited and you chased, instead of having some patience and waiting and analyzing, now you're probably stuck in this 7 to 8 cent range. Whereas if you had patience and you waited to see if it could break the high of the day within those first 5 minutes, which it did not, you would have then positioned for maybe this gap to fill, like we've started to see on Apple stock, started to fill the gap. The same concepts apply in penny stocks and big board stocks. So, now you could get it here at 6.5, and the chart looks pretty good now because it looks bottomed out. All right. SPY. You can see again. Opened at 135.24 or so from a close of 134.20 from Friday. And if you bought calls on that first gap up, again, you bought with the minimum amount of time decay factored in and the most amount of premium factored in. And you can see it never broke that high and has since retraced. Okay? So, it goes both ways. And this is why you really need to exercise patience. You need to understand that you're not going to always make the maximum gain possible. That's just not how things work. If that's how it worked, then everybody would have success in the marketplace. What's going to separate consistent success from making money and then losing money is some people are going to look at Priceline today and they're going to say, oh man, I bought right away on the gap up and that worked great. I'm going to do that again. I don't need to wait. I can just buy right at the open. Some people are going to look at NSRS and they're going to say, oh, I don't need to wait. I can just buy right at the open. But what's going to happen is they're going to fall into that strategy of that bad habit of not waiting and not having patience. And it worked today, but next time they're going to try the same strategy on Apple and it's not going to work. Next time they're going to try the same strategy on SPLI and it's not going to work. Next time they're going to try the same strategy on SPY and it's not going to work. So we would rather teach traders to develop a strategy that can always work, okay? And that is a strategy that includes patience and a clearer picture. What we mean is if you allow the first couple minutes of trading to happen, you can come up with a much better understanding of what levels a stock or an ETF needs to break above in order to have further upside.